It is live. All right, guys, this is the March 25th meeting of the Mmic, Money Masters Investment Club. I'm Dr. Robinson, and we're going to talk about a few things, and then we're going to do our normal thing when we do a live meeting and do a little bit of training. But there's a couple of things I wanted to show you. Of course, we're going to do the financials and stuff, so I'm going to kind of get right to it. There's probably going to be some people coming in. Do need to mute somebody. Um, Keep in mind, guys, this is live, so and we're recording it, so anything you say will be held against you in a court of law or so. If you have any questions, certainly ask me questions and stuff because those would be good for the website as well. In any event, March 25th meeting, let's get to it. So in terms of the financials, so we had a pretty good week last week. Consistent. I need to be a little bit, or I'm getting back to the point where I'm starting to add more and more contracts. I've still kind of been limiting myself to, say, 450 contracts as a maximum. There's a couple of times I've only done 100 contracts, but trying to be safe during. We're still seeing a lot of volatility, especially these retracements we talked about a few weeks ago, where you might be up 30, 40 cents. One of the traders this week was in a position where they were up, and I forget the number. I think it was up $2,500 in a particular trade really quick, and then before he could even do anything about it, he was down 300. So the market is very volatile at moments, and it's tough. So what I've been doing lately has been doing smaller contract sizes just to keep us from getting into a position where on a retracement when a retracement hits that I have to take a loss or something just to kind of protect the accounts and stuff. So I've been doing smaller accounts or smaller trades so that I can kind of hang in there a little bit longer on the retracements and see if they come back. Previous NAV from 316 was 24.23. This week we gained 78 cents. So the NAV this week 25.01. That's a 3.22% increase for the week. So pretty good week overall. Again, it would have been a little bit better if I'd been doing a little bit bigger contracts, but for the moment, I'm comfortable doing the 450 in terms of 450 contracts. For those of you don't really understand the options, that's about 45,000 shares at any one time. And that's about the most I'm comfortable doing right now. Again, it gives me a chance to, if I need to strangle or double down or something, I can handle 900 contracts. That's 90,000 shares. I can handle that pretty well. Just don't want to get into a position right now where I have to double down or something on 1,000, 2,000 to 3,000. Not comfortable with those right now, especially with the way the market is working. So overall, pretty good week. Pretty happy with what's going on. So from here, just a couple of things. Wanted to show you guys some trend lines. I'm still convinced the market is more trending more to the downside than it is to the upside. We can kind of talk about which way is the market heading. There's all kinds of people out there who still believe, and again, I'm not sure where they get their information, or if they're listening to the Fed, or they're just convinced that the Fed is going to do what they want them to do. Still, a bunch of people believe the Fed is going to lower interest rates next in the next meeting in May. I think we're going to see another increase of 25 basis points in May. Whether we see any more after that, I don't know. But again, Morgan Stanley's saying that after May, we're going to start seeing decreases. Again, the Fed has been pretty clear. They're not interested right now in staving off any kind of recession. They're willing to go through the recession because the inflation issue is still big. We saw some European inflation come in last week, on Thursday and Friday of this week, by the way, and the inflation is still increasing over there. Whether that translates into inflation over here, our last print on inflation here was actually fairly low. Wasn't as low as, of course, they want, but it's heading in the right direction. We had January that kind of increased, or I'm sorry, it was February that increased kind of surprisingly, but March kind of went back down to the trend line. So whether February was an anomaly or if it was just a harbinger of something to come, not really sure. But inflation is going in the right direction here in the States. But I don't think that means that the Fed is going to start lowering interest rates anytime soon. They can't increase the money supply. There's a couple of reasons for it, by the way, and I think I've got them in the slide, and I'll kind of talk about them while we go through it. I'm kind of doing this off the top of my head because I wasn't thinking about this as I was doing the slides yesterday. But it's kind of it's one of those things where you start thinking about other issues that could come along. But let's talk about why I think the market's heading the way I think it's going to head. So this is an example of, and I'm just going to do the S&P. I'm not going to do the Russell and the Dow and all that other stuff. But in terms of the S&P 500 chart, this is the weekly chart, and you can see for all of 2022, we kind of were in a downtrend, and it mostly started because of the interest rate increases and stuff that we started seeing in the spring. But the downtrend has been pretty steady right up through this year. Now, the beginning of this year, we did have a little bit of a run. Again, a lot of people started thinking the Fed had done enough, the interest rates might come back down, the money supply could go back up, and all that other stuff. But I kept telling you guys, and I was just convinced that the Fed was going to keep the line. They made a huge mistake when they told us a year ago, a little over a year ago now, that the inflation was transitory. And they've got egg on their face, and I don't think they're going to be so easy to get off of where they're at right now on the inflation. Clearly, the inflation wasn't transitory. And if you looked at basic economics, you kind of knew that it wasn't transitory. So I never really understood where they were getting the transitory issue from. But at the end of the day, in 2023, at the beginning of the year, market did kind of come up a little or quite a bit. So it had a little bit of a rally, but the rally failed for the moment. Now, I don't think the rally is necessarily done because we still haven't retested our low. But this is the weekly chart for all of the just the weekly update of the S&P 500 for a few years now. You can see the trend line there. So the trend line is down. We keep hitting that top, and once it hits that top trend line, the market kind of comes back down. Now you can see in 2023, we did kind of go above that trend line. It tried to hold, it couldn't, and it's kind of gone back to, and if you look to the far right, it's kind of gone back to where the trend line would be. Now, whether it can hold here or not, I don't know yet. I don't personally think it can, and I'll tell you why in just a moment. But this is the trend line we look at on terms of a weekly basis. But we can also look at this chart from a monthly basis. The monthly basis, you go out a little further period of time. Of course, we're going back to 2003 on this chart. If you look at the beginning of the uptrend, that was from 2009. This is just about the time of the financial crisis that we all went through. You can see that the trend line here has been up since about that time, especially starting officially a little after 2010, because you can see where that low was at. But that trend line has held all the way till now. The problem with this trend line on this monthly side is that there's a lot of resistance up there at that 4,800 level. Now, of course, 4,800 on the S&P was a record. We've never been that high before. It's going to be tough to break that, especially with the economy we have today, with Joe Biden in office, and nothing personal to Joe Biden, but he's not an economic genius, and he wants to do some things that might actually be bad for the economy in terms of raising taxes and stuff. But the resistance level is pretty strong. I don't know that there's anything in our economy today that could get us above that resistance level. So the resistance level there really high. But you'll notice that the support levels, there's actually 3 of them there. And the first one, the one that says not tested yet above it, that's where we're at right now. So that level's right around, right now we're about 3,900 on the S&P. We're trading between 3,900 on that. The funny thing, and this is why there's so much volatility in the market right now, we've been trading between the 3,900 to say 4,000 on the S&P to maybe 4,010 on the S&P, because it did bounce up there a couple of times. But we've been trading there most of this year. So we've had a tough time, especially through all of February, by the way. We've had a tough time to get out of that trend line or that channel. We haven't tested the low. The low's at 3,600, kind of where that arrow is pointing. We haven't tested it. We hit it once, but we've not hit it again. Normally, to confirm a trend line, you have to hit it twice. We call it a test of the trend line. We haven't hit it yet. That's actually very concerning if you're a technical trader, and that's what we do in options trading. By the way, we do technical trading. So on the technical side, it hasn't hit that trend line again yet. We need to hit it and then bounce off it. If we bounce off it, there's a better chance of the market going higher than there is lower. If we go back to that 3,600 level and fall from there, then that's where the other two trend lines come into play, because there's nothing to stop a decline there until we get down to say 2,400 and then potentially 1,800 on the S&P. Those are the only other two support lines on the monthly chart. So if we can't get above that 30 or can't stay above the 36, this thing falls hard. And there's a better chance of us going down from here than going up. And the reason I say that is just simply because of some of the things going on in the economy. For example, we have rising labor costs. They're still going up. Now, that's part of it. Part of it is the inflation. Part of it is there's just still a lot of people in the marketplace who are willing to take jobs, and there's more positions available, I should say, than there are people to take those jobs. And again, if you're a company and you're trying to draw somebody to take a job, if you have to take them from a previous job, you have to offer them more money or more benefits or something else better, maybe a corner office, who knows? But you have to offer them something better, otherwise they're not going to come over. So that's inflationary in and of itself. We also have falling corporate profits. If you've been following corporate profits at all, S&P profits are going to be coming down to say 122. They were in the 130s and 140s for some companies, but we're going to start seeing those fall to 122. I think they're going to fall a little lower than that. I think we're going to go back to levels we haven't seen since about 2012, 2013 in terms of actual corporate profits, probably somewhere in the neighborhood of 112 on the S&P 500. Now, that's an average on the S&P 500, by the way. It's not for individual companies. But we are seeing falling corporate profits. And remember the one thing about, and I've told you guys this for years, if you want to know where a stock is heading, you have to follow its earnings. Earnings dictate stock prices. When a company's earnings fall, the stock price falls. When companies' earnings go up, stock prices go up. Now, it is easy for companies to cheat. Now, I thought that would be one of our things we talk about next time we do a live meeting. There's an easy way for a company to cheat, and it's legal, by the way, on their earnings per share. And for those of you who know anything about how to calculate the value of a stock, one of the easiest things for a company to do is buy back its stock. Now, from an economic point of view, there's no reason under the sun for a company to buy back its stock. There's no economic benefit to the company. Because, of course, the company, in fact, there's a lot of things that go against it. The company has to take cash out of their bank accounts, if you will, to buy that stock back, or they're going to borrow or issue bonds or whatever. They're going to raise money somehow to buy that stock back. But other than seeing their financials change a little bit, there's no real reason for a company to buy back its stock. So why do companies buy back their stock? Well, they buy back their stock because it increases their earnings per share. And it makes it appear, it's not real, but it makes it appear as if their earnings are going up. And let me put this in simple terms for you. Let's say I have 100,000 shares out there, and my earnings per share is $2. If I buy back, let's say 10,000 of my shares, so instead of having 100,000 shares in the market, I buy back 10,000, I have 90,000. If my earnings are still the same, if they didn't change at all, $2 a share, if they don't change, then what happens is we're going to divide our earnings by fewer numbers of shares, which means our earnings per share might be 225 or 230. And I'm just throwing numbers off the top of my head. I'm not doing the actual math. But it makes it look like the earnings per share is going up. And then investors who don't pay attention, which is most investors, they look at it and say, hey, this company's earnings per share went from 2 to 225, so the stock is obviously moving in the right direction, so I'm going to buy that stock. And they drive the price of the stock higher. That's the reason companies buy back their stock. It makes it look like the earnings per share is going up, when in reality it's not. The earnings per share didn't change. The company earned the same amount of money as it had previously. It spread that money out over fewer numbers of shares. So it kind of looks like their earnings go up. So when we talk about watching a company's corporate profits and earnings per share and stuff, the first thing we got to do to test it is to make sure they're not buying back their stock and making it look like their stock or their earnings per share is increasing, as opposed to a company just really generically or fundamentally increasing the earnings per share. Now, if you talk about a company like Apple, Apple is increasing its earnings per share on a true basis. Now they're still buying back their stock. So when they buy back their stock, it kind of muddies the water again. So they are still buying back their stock, which I wish Tim Cook would stop doing because the company doesn't need to buy back that stock. But at the end of the day, again, corporate corporate profits are good. You know, if we can make their earnings per share look better, that makes the board of directors come along to Tim Cook and say, "Hey, we're going to give you a raise for making the earnings per share go up from $12 to 12.50 or to 13 or whatever it may be." We're also seeing some stress on the banks. When SVB went down, was it 2 weeks now or 3 weeks ago? I wasn't all that concerned about it. It took me by surprise a little bit. I wasn't expecting to see that, but it turns out there's a lot more banks out there that are struggling a little bit to deal with these rising interest rates. And that's taken me aback a little bit because, if this was 20 years ago, I don't think we would be having these troubles. But the Fed has kept interest rates down for so long that I think a lot of the risk managers, or what we call the duration managers at a bank, have forgotten to do or how to do or manage duration risk. And the more we start seeing of this, because now we're starting to hear rumblings that Deutsche Bank out of Germany is struggling a little bit. Maybe some of the bigger regional banks in the U.S. U.S. Bank has got there's some rumblings that maybe their duration risk hasn't been properly mitigated as well. So there are some fundamental issues starting to come to light. I still don't think we're going to see anything near, and I'm going to come out and say again, this is not 2008, 2009 again. We're not going to see big banks come down. They went down back in 2008 and 2009 for different reasons. We are starting to see, though, and one of the things I was talking about with somebody yesterday, one of the things we pay attention to is something called a credit default swap, and we've never really talked about those. I don't invest in those at all. Those are mostly big time money. Those are investments, by the way, to indemnify a bondholder in the event the bond goes under and it can't be paid. I've bought them in terms of, or I've been covered by them in the past where, when General Motors went into bankruptcy, because I had clients back in 2008 that had General Motors bonds. And when General Motors went into bankruptcy, we have the credit default swaps cover us for the losses. So it's an insurance policy. And that's why a lot of insurance companies own them. Insurance companies, they're in the business of insuring risk, and a lot of insurance companies will buy or issue credit default swaps and cover the cost of a big company or even a bank going under. Well, the premiums on those have been rising lately. We've started to see, even for some of the bigger banks, for example, U.S. Bank saw their rates or their credit default swap prices rise. Now, is it rising because U.S. Bank is in trouble themselves? I don't think so. I think it's more the market is starting to get a little bit nervous, thinking, hey, what other banks out there are we potentially on the hook for? So they're starting to increase premiums to cover the cost of losses that are either already happening or that they suspect might happen in the next few months. We are starting to see credit default swap prices increase. That's not good news for the market, and that is something that if it continues to happen, this is what actually happened or brought down Lehman Brothers back years ago, by the way. They issued a whole bunch of credit default swaps, and when those things came due, they didn't have the cash to pay them or to make the payments. So one of the things we will watch and see is if those credit default swaps continue to do what they're doing. I don't think they will, by the way. I don't think the increases we have seen, even though we've seen some increases in the prices of those swaps, the prices we're not talking major increases like we saw back with Lehman Brothers back in the 2008 era or so. 2007, I think, is when they went down. But we're not seeing those kinds of increases, but we are starting to see some increases in the prices. So we'll keep that in mind and we'll watch it and see what happens, but not something that I think that we have to worry too much about. We're also seeing falling consumer spending. A lot of people are worried that a recession is coming. I think we're probably going to see a deeper recession than I originally thought, mostly because I think the government's doing some things that they shouldn't be doing. But in any event, consumer spending is coming down. Biden right now is wanting to raise taxes. I've heard estimates of somewhere between $5 and $7 trillion over a 10-year period. Bad decision. You never raise taxes in a recession or anywhere near a recession. You only raise taxes in a good economy. But again, not a very good economist. Growing deficits. The deficits this year, 1.3 trillion. We're expecting 1.7 trillion in the next couple of years. So as these deficits go up, the government spending's got to come down. Of course, politicians are not going to reduce spending. They want to get elected, and the best way to get elected is just to keep spending money like a drunk sailor. Deglobalization. I'm not a big fan of this one. I don't see this to any major extent. We saw for the last 20, 30 years, we've seen a lot of globalization where companies are kind of going abroad, and we're starting to see a little bit of a reversal on that, and that is true, but I don't think it's sustainable in any meaningful way. China and Russia are kind of changing things a little bit where they're kind of scaring companies out, but if you think about some of the companies that went to China, Apple and General Motors and all these companies, it's not easy for them to come out of China, and they would end up leaving a lot of assets there if they did. So I don't think it's as bad as some people think it is, but it is increasing. So I'm in terms of is deglobalization happening? The answer to that is yes. Is it happening to such an extent that economically it might change things fundamentally? The answer to that is I think it's a no. Inflation Reduction Act, again, adds to the deficit. I'm not going to talk to you more about that. And then climate rules and regulations. These are the reasons I don't think that, I think that going back to our charts, the reason I think that we're going to see a testing of the lows or support levels as opposed to a resistance level up there at 4,800, we're more likely to go down from here than we are to go up. I do see us trying to make a test of that 3,600. When that's going to happen, I don't know. It should have happened by now. Normally, when you have hit a low and then you have to retest it, you usually retest it within 90 days of the original low, and we're well past 90 days. So whether that was, it could be that was an anomaly. I think more than anything, though, it's just a lot of people just fighting the Fed right now. They're wanting to go or wanting to believe that the Fed is going to cut interest rates. By the way, and you could buy options on this kind of stuff too. We don't, of course, but there are people out there who make bets about whether the Fed is going to, raise interest rates by how much and all that sort of thing. There's a lot of people. There's actually 33% of investors out there are actually taking bets that the Fed is going to lower interest rates by June of this year. I think they're smoking something funny, but if you've got 33% of investors, actually 1/3 was the number. You got a third of investors out there, and I don't know who they're talking to, but there's a third of people out there thinking that somehow the Fed is going to lower interest rates. I don't see it. I mean, anything can happen. If the bank failures start ratcheting up and stuff, then maybe yes. But even if they do increase the money supply at that time, they're just going to increase the money supply to cover the banks, cover the bank deposits and stuff. So it's not like it's going to trickle down into the economy in any meaningful terms because the banks are not going to lend that money. The banks are not stupid. If they're getting into financial trouble, any money they get from the Fed is just going to go into their vault as reserves, as backup. It's kind of an emergency fund type thing. They're not going to be lending that money out, so it's not going to help the economy. So the people who think that the Fed might have to lower interest rates and that's going to be a boom for the economy, I think are dead wrong. But again, who am I? So what I wanted to do though is just in case, if the economy or if the Fed does lower interest rates and the economy starts on a boom, it's going to be time for us to start picking stocks and getting back into the market. So the first thing I wanted to do is do a little bit of a primer, and again, I'm going to do this over the next couple of months as we talk about how to pick stocks and all that sort of thing. For those of you who aren't my clients, if you're one of my paid clients, I actually pick the stocks for you. So I kind of do this on my own, but if you're not a client and you're trying to figure out, hey, what's a good stock to buy and all that stuff, there's so many financial formulas that we look at in terms of, hey, this is a good stock, that's not a good stock, and all that sort of thing. So what I want to do is kind of pick a couple of things and a couple of formulas that we use in picking stocks and kind of elaborate on them a little bit, how to use them properly. Some of them are simple, by the way, and the one we're going to do today is the PE ratio. PE ratio is actually a fairly simple ratio, but most people use it incorrectly. So it may be a good, easy formula to calculate, but if you're using it wrong, it doesn't really help you. So let's look at a couple of a ratio, actually just one ratio, and how to use it. So the most abused ratio used by retail and professional investors is the PE ratio. The PE ratio is price to earnings. And we just simply call it the PE ratio because it's P over E, price over earnings. Now, historically, the average PE ratio for a publicly traded stock is 15. Now, what this means, by the way, a lot of people don't understand what a PE ratio means, but a PE ratio means how much are you going to pay for a stock for every $1 of a company's earnings? So if you have a PE ratio of 15, historic average, then you're going to pay $15 for every $1 of that company's earnings. So if a company has, let's say, for example, $2 of earnings, what would the stock price be? $30, 15 times 2. If a stock has $3 of earnings and it has a 15 ratio, 15 PE, then I would expect to pay $45 for that stock. I'm picking up background from somebody. I'm not sure who it is. Russell, that was you. So I'm gonna mute you, Russell. Sorry about that. But in any event, what we want to do is we want to make sure that the PE ratio is legitimate. That's what a PE ratio it is. It just simply tells me how much am I paying for every $1 of earnings. Now, of course, value stocks, you guys have heard of the term value stocks. Value stocks are stocks that have low PEs. They might have a PE ratio of 4 or 5, maybe even lower, maybe a 3. In other words, you're only paying $3 for every $1 of earnings. And you would think of that as being a good thing. And it might be, and I say might because it might not be. Who knows? We got to do some more research. We can't just look at a PE ratio and say, hey, that PE ratio is below 15 or it's really low, and therefore it's got to be a good stock. Remember, if a company has a low price, there might be a reason for it. So sometimes a company is just not well run or it's in trouble. And so the stock price is down. And a lot of people buy it, just simply say, hey, this company's got a PE ratio of 2, and they say, oh, I got to buy that stock with a PE ratio of 2. And over the next 5 years, the stock does nothing. And you're like, well, why is this stock not doing anything when the PE ratio was 2? Well, PE ratio was 2 because the company's horrible. They're not selling anything, or their management sucks, or there's a lot of different reasons it could be. But going off of our basics, a PE ratio above 15 means a stock may be overvalued. And in general, you don't want to buy an overvalued stock because that stock is more likely to come down than it is to go up. A PE ratio below 15 means the stock may be undervalued, could be a value stock. But again, it's not hard. It's not this is just a hard fast rule. It's kind of a quick and dirty rule. But just because a stock is above 15 doesn't mean you shouldn't buy it. Apple's been above 15 for a long time. And just because it's below 15 doesn't mean it's automatically a valued stock. You still have to do a little bit more research. So, but the general rule is 15 is kind of the cutoff. A stock greater than 15 on PE ratio is fairly expensive. You don't want to pay too much for that stock. Let's look at an example. A company has earnings per share of $3.25. The stock is trading at $35 a share. Is this a good stock or a good PE? Well, to do the math, we just simply divide the price, the $35, by the earnings per share, $3.25, and we get a PE ratio of 10.77. Now, technically, we would say this is 10.77 to 1, which means this stock costs $10.77 for every $1 of earnings. But in the real world, we just dropped the to-1 part. So in this case, this stock has a PE ratio of 10.77. Now, compared to the historic average, this stock is a value stock. The stock is undervalued. But we can't, again, we still have to test it. And there's a lot of different ways to test it. But on the surface, this appears to be an undervalued stock. So this would be a stock that I might be a little bit interested in. It doesn't mean I'm interested in terms of I'm actually going to buy it right now. It just simply means I need to do a little bit more due diligence. There's more things for me to look at to see if this is a stock that might be good for my portfolio. So in this case, this stock has an attractive PE. I might be interested, but I still need to do some other work. I want to look at their balance sheet. I want to look at their income statement. I also want to look a little bit deeper into their PE ratio. And I'll tell you why in just a second. But in other words, this investor would pay $10.77 for every $1 of corporate earnings. Again, sounds attractive because the norm is 15, so I'm like $5. It's not quite $5, but I'm $4 and 30 something cents below the average price for this stock. Might be attractive to me, but we have only time will tell though. Is this a good PE ratio? So many investors make two mistakes when using a PE ratio to help make investment decisions. First, they compare a calculated PE to the historic average. The result is meaningless. When I talk about the historic average of PE ratios, we're talking about the American historic average. This dates to early 1900s. Most of the companies that were around in the 1900s aren't around today. There's a few, GE, General Motors, Ford. They've been around for a long time. But even if I'm looking at Ford, General Motors, and GE, do I want to compare Ford, General Motors, and GE today to what they were 120 years ago? The answer is no. And on the other side of this, there's a lot of other companies that have never been haven't been around that long. Apple's only been around since the 1970s. So do I want to use historic averages for actual comparisons of companies? And the answer to that is no. What use is it of looking at a company in 2023 compared to the historic averages of 120 years of stock prices? It's meaningless to me. So I don't use it that way. A lot of investors do. Oh, this stock, the historic average is 15. This stock's got a PE ratio of 12. It's undervalued. I'm going to buy a whole bunch of it. And then they end up losing their shirts on it. They're like, how did that happen? Because the PE ratio was low. Well, it was low compared to a historic average, which is a meaningless term. The second mistake they make is comparing dissimilar industries. Comparing Apple, for example, to General Motors. Why in the world would I compare Apple to General Motors? They're in two different industries. Apple's a tech company. General Motors, of course, is an automaker. They do different things. General Motors is cyclical. General Motors goes with the economy, and we've talked about the business cycle before. When the economy is doing well, General Motors does well. When the economy is doing lousy, General Motors does lousy. Apple does well in almost all economies. Yeah, they do slow down in a bad economy. They don't sell as many phones, but they still sell a bunch. So Apple, I don't want to compare Apple to General Motors or Ford. That's like comparing apples to bananas. There's just no comparison between the two. So I don't want to do that kind of stuff. What I want to do, if I'm going to use a PE ratio, I want to use it in the same industry. So if I'm going to compare Apple, I want to compare Apple to, say, Samsung. Or if I'm going to compare Verizon, I want to compare it to AT&T. I want to compare it to their competitors, and T-Mobile maybe. So I want to compare it to their competitors. I don't want to compare PE ratios to businesses in different industries. That's a little harder than it sounds, by the way. And even then, I'm not a big fan of that because, again, just because AT&T and Verizon and T-Mobile are all in the same industry, they have different things going on in their businesses. AT&T is the lousiest of those three, by the way. They just have such a high debt load. Now they've offloaded a bunch of their debt recently with their spinoff of DirecTV and that movie studio they had, but still the company is struggling. Now they're getting better because they don't have all that debt that they had. But comparing them to Verizon and stuff, again, it's almost apples to oranges again. The best use of the PE ratio, to me, is to compare the PE ratio of a company against itself. So the best use of PE is to compare the price to earnings ratio of the same company over time, say a period of 10 years. Some people go back 20 years. I think 20 is a little bit too long. These companies, even the same company can change a lot in 20 years. Think about General Motors. 20 years ago, electric vehicles weren't even they may have been on the drawing board, but they certainly weren't in process of being built. Now the company's thinking that by 2030, 2035, it's going to be all electric vehicles. So you got to be prudent in comparing a company against itself. You don't want to compare it against, a 30-year history of a company compared to today. That might be just a little too far along or too big of a stretch. But I certainly want to compare it to 10 years because even 10 years ago, General Motors was still actively looking for or how to build electric vehicles, and so it was at least on the drawing board. And of course, since it was on the drawing board, they're starting to make projections for growth and all that sort of thing. So that's a fair comparison. So let's do an example. So a company with a 10.77 PE ratio might today sound like a relatively undervalued company because it's below the 15 historic average, sounds pretty good. But if we examine the 10-year average PE ratio of our example company, it's 5. So the company we've looked at over the last 10 years, their average PE ratio was 5, and now it's 10.77. That company is wildly overvalued. That company's not undervalued. So when you use a PE ratio, you've got to use it on the company itself. And a lot of people don't do that. They just simply say, I'm going to compare this company to, let's say, Verizon or some other competitor, but don't compare it to themselves. But that's the biggest mistake you can make. If I know a company has a 10.77 PE ratio and their historic average over the last 5 years is 5, I'm not touching that stock. That stock is probably overvalued by basically twice as much. I want that stock price to come down before I would even consider buying it. And by the way, I probably wouldn't consider buying it until the stock, or the PE ratio rather, was down around 3 or 4. And if it's at 10.77, it might be years before that happens. It might be 1 year, could be 2 years, 3 years. It might be 6 months. Who knows? Maybe something big is going to happen. But I don't even want to consider buying that stock until that PE ratio comes down. The same is true on the opposite side, by the way. Apple. Apple has a PE ratio right now of about 33, which is way above the historic average. Now, it's actually over Apple's 10-year history average, too. Their 10-year average is about 26. So if you've got Apple at 33 and their average is 26, the stock is still overvalued. It's more likely to come down in the next few months than it is to go up. So again, I love Apple. I own a lot of it, and almost all of my clients at some point own it. Not all of them are holding it right now, but if you've bought it more than 10 or 15 years ago, we're still holding it. It's just one of our legacy stocks. It's a stock we never get rid of because there's no reason to get rid of it. So if I'm thinking somebody should have some Apple stock in their portfolio, and I think everybody should, am I going to buy it now? No, still a little bit overvalued. I want that number to come down a little bit. I'd like to see the stock, and I think the stock price is somewhere right around 160 right now, 159. I haven't looked at it. I didn't see it from the close yesterday. My internet went down yesterday afternoon. I couldn't see anything. But if I assume that Apple's at 160, give or take, I'd want the stock to come down to maybe 140 before I get a chance to buy it. By the way, 6 to 8 weeks ago, the stock was at 135, and so it was pretty good. Actually, it was 128 back in January. So there might be some, better chances to buy the stock in the future. So I don't want to buy it yet. So this works both ways. I always want to know what the average PE ratio of my company is over the last 10 years. That gives me a good indication of whether this company is overvalued right now, undervalued, and all that sort of thing. If you buy a stock that looks like or appears to have a low PE, but in reality it doesn't. For example, let's go back to the example we were using. If I buy a stock of a company that has a PE ratio of 10.77, and I find out later on after I bought the stock because I thought it was a value stock, and I find out later on the historic average was 5, I'm in what's called a value trap. And what that means is, again, because the stock historically has a PE ratio right around 5, I've paid twice as much for the stock. The stock is going to struggle to grow from here. So you may have bought the stock thinking you had a value stock. And a value stock is a stock where you buy it with very little risk because it has a greater chance of growth in the future. But just the opposite has actually happened here. You're stuck with the stock. And now what happens is as time goes on, the stock is likely to go down in value to get closer to that PE ratio of 5, the historic average, which means the stock has to come down in value. So as the stock comes down, you don't want to sell. You're like, oh, this is going to come back. It's kind of what we do in options sometimes. The market's going to come back, or the stock is going to come back, and then it doesn't. It goes from maybe $35 of value down to $30 of value, and then down to $25 of value, and then 20. And you're like, I'm still going to hold it because I think it's coming back. And the next thing you know, the stock's at 15. And then it stops. And maybe 15, and I'm just throwing out some numbers, maybe 15 is about where the PE ratio is 5. And now the stock is properly priced. So now the stock's at 15. You bought it at 35. So you're underwater by a bunch, and you're trying to figure out what to do, you're trapped. If you sell it, you take an unrealized loss and make it a realized loss, a real loss. But if you don't sell it, you're down half on the stock. You've lost 50%. Do you hold? Do is this one? And now again, it's stock. You can do whatever you want. My guess would be you're probably going to hold. Most people hold as long as it doesn't go down too much further. As long as the company stays out of the news, no bad news type of thing. You just made a mistake in thinking you're buying a value stock when in reality you were buying a value trap. Now you're trapped in the stock. You don't know what to do. You don't want to take the loss if you can avoid it. You're still optimistic it's going to come, but you're worried it's going to go from 15 because it could go down to 10, could go down to 5, it could go down even further, could go to 0. It's not likely unless the company was into bankruptcy. But still, you just bought the stock too high, even though you looked at the PE ratio and thought, hey, that's a great PE ratio because it was below the national average. That's the biggest mistake people make. So if you're starting to think about buying stocks in the marketplace, one of the best things you can do is look at the PE ratio, but make sure you know what that company's PE ratio is over the last 10 years. If you don't, you're going to make a huge mistake. I shouldn't say you're going to. You could make a huge mistake and get yourself into a stock that you can't get out of because the stock just simply won't grow from where you're at because you paid too much for it on the PE ratio, thinking that it was a good deal. In reality, it's not. All right. That was my last slide, guys. So I'm going to open it up to you. We've been going about 41 minutes or so. So if you have any questions for me, let me know. I don't see anything on the chat. So if there's no other questions, we'll see you. We'll do another training in about a month or so. We do remember it's the last Saturday of every month, same bat channel sort of thing. But other than that, if there's no questions, we'll see you guys. For those of you on the call on the daily basis, we'll see you on Monday, and for the others, I'll see you in a month or so. You're welcome. You're welcome. Thank you. Sure. Absolutely. Was that who was asking that? Was that Adam? And is that Adam? That's got to be Adam Schaffel or Saffel rather. Yeah. Okay. Okay. I'll do that. You're welcome.